The bears, the top three bears in my spring quarter, all right, as I'm going into the spring quarter, are in the communication sector, they're in the staples sector, and they are also in, guess what, as we get to the end of the quarter, oil and gas exploration. So what are those top three stocks? Let me give them to you right now. So number one is Verizon. Verizon. Now, when you take a look at this table that I have here, all right, this table I'm pulling from something called the money calendar. And the money calendar is really my tool. I was gonna patent it. We were planning on patenting it, and we decided right at the end of the patent. So we hung on to patent pending, and right before the patent was to be filed, we pulled it because I did not want to put it out there in the public. And the reason why is because when you patent something, you have all that public information out there. And by the way, who's going to follow a patent, right? We know there's certain countries out there that don't follow patents, but I decided to pull that and keep that to myself. So we have a specific way that is different than the calendar way that we look at patterns. The patterns are both bullish and bearish. And as you can see here with Verizon, going into Q2, Verizon's actually been an interesting stock. It's been an interesting play. It's a dividend stock. However, if I were looking at buying Verizon, I would not buy it for the next 22 days, simply because there's a 22-day bear drop that averages about a 3% move to the downside. So when I look at these tables, you might be saying, but Tom, no, I see bullishness. I see all this green on the screen. This green is if you were to short the stock today, and you were to do this over the last 10 years, going forward 22 days, starting the first week of April, what would that do for you? Well, shorting it, you would have made 1% in 2016, 5% in 2017, 1.5% in 2018, 2.5% in 2019, almost 1% in 2020. Now, you would have lost money in 2021 because Verizon actually went up during these 22 days during 2021. But in 22, 23, 24, and last year, we had some really big moves. The biggest move was during the bear market of 2022. Verizon went up by 11%. All right, or went down. Excuse me, went down by 11%. The stock, the shorts, did very well on that particular trade, and that was just a small 22-day slice of the bear market in 2022. But we had bullish markets in 23, 24, and 25. And in each of those years, Verizon dropped. Okay, so the green on the screen tells you the percent return based on the bullish, or in this case, bearish pattern. So that's Verizon. Let's take a look at trade number two that I don't want in my portfolio this spring. And that would be Smuckers. JM Smucker, the peanut butter makers. There's a 39-day bear that starts on May 4th and runs out 39 days. The only time that bear did not work was in 2016. But in 9 of the last 9 years, peanut butter, for some reason, has fallen between May 4th and moving forward 39 days. Okay? And so if you look at at shorting these, that means you would sell it, in this case, sell on May 4th. And look what happened last year. If you sold it on May 4th of last year, Smuckers dropped almost 14%, which means that you'd sell it on May 4th, you'd buy it back 39 trading days later, and you would have replicated that return. Now, there's a question that's popping up that says, and I'm going to take questions. I've got a couple of areas I'm going to take questions in. But when you short, doesn't it mean you buy a put? No, I'm talking about when you borrow the stock and you sell it, and then you buy it back, and then you give the stock back to whoever you borrowed it from, right? But buying puts is another way. Buying puts on JM Smucker last year was incredible good idea, right? So that's that buying a put option would be very similar, at least in direction, to shorten the stock. But there are some differences in stock versus options. I'm going to talk about those, what those differences are here momentarily. But again, there's number two. So So I talked about communications, and this is a staple right here. All right, JM Smucker is a staple. It's a staple in my household. I love peanut butter. I'm not allergic to peanuts. I don't know what I'd do if I was allergic to peanuts, but I'm allergic to JM Smucker starting May 4th. All right, I don't want that on the long side of my portfolio. Okay. Finally, let's talk about oil and gas. It's been a big thing, oil and gas. All right. Oil and gas, in fact, the oil market, as you may all may know, has gone up and literally doubled in value in the first quarter of this year. Okay. Every time you turn on the television, you're looking at TV or you're looking at streaming, and you're streaming anything that has to do with news and stock market, oil, gas, and Iran and the Strait of Hormuz is in those headlines. And of course, if you're with me live today, then apparently in about 4 hours, a little less than 4 hours, we may see some movement again. Uncertainty might become certain. We don't know what that's going to be. But I'll tell you this, I think oil and gas is already overdone. And to make a double in 3 months, could it continue to go higher? Absolutely. But the probabilities is that oil and gas have, for the most part, run out of gas to the upside. And, we're looking at volatility. We're looking at option volatility, and the option traders are telling us that the panic was really 2 weeks ago. It's not so much of a panic now, but it can happen again. The probabilities are that it doesn't. But we're also seeing, that when we get to June, we're seeing that whole seasonality on oil and gas starts to roll over in June and really starts to kick in July. And so by the time we get to summertime, I'm going to be well out of any oil and gas plays that I am in right now.